Hello, I'm Bryce Knorr, Senior Editor of Farm Futures Magazine, and welcome to The Buzz for Thursday, October 18th, 2012. The grain market gave growers a scare this week with a precipitous plunge, but futures came roaring back, trying to confirm harvest lows. So what's ahead for prices, and what should you be doing about it? Let's start with corn. After rocketing higher on the bullish October 11th USDA crop report, the market suffered follow-through selling to start the week from last Friday's week close. December futures was able to hold the previous week's lows, and now is trying to rally back towards multiple points of resistance around $7.75 to $7.80 a bushel, including the post-report high, the 50-day moving average, and the 50% retracement of the August to September sell-off. After that, there's more resistance around $7.95. Very tight supplies of corn increase rally potential, despite of, or perhaps because of, the need for rationing that's already begun. Ethanol production dropped 3,000 barrels in the latest week, falling to a rate that's around 100 million bushels less than USDA forecasts for the marketing year. Exports also remain very slow lately, just 6.6 million bushels in the latest week. Thanks to a strong book this summer, total commitments are still running at a faster than normal pace, but the edge is definitely slowing. While farmers in the east are still harvesting corn, work is starting to wind down in the west. With that crop locked away tight, basis is strong and getting stronger. My goal for pricing remaining 2012 crop inventory is first, do no harm. While my research shows strong potential for rallies that could very well make new all-time highs, I also don't recommend gambling on a price that could be less than the harvest guarantee for revenue protection policies. Getting at least the average price for October on sales should ensure that. The idea is to keep a trailing stop under the market to give the upside some room. The break below the short-term trend line this week should have triggered a small sale, now put the next stop below last week's low, 732 1/4. If it gets hit, this market may not have the strength I think it should have. Weakness in corn came partly from a downdraft in soybeans early in the week. November futures plunged below $15 on fund liquidation caused by the increase in production noticed October 11th by USDA. The market worked into the July 4th gap I've been talking about but couldn't fill it, triggering a rebound rally that's trying to confirm a harvest low. Soybean exports remain strong, but much of the recent demand appears to be coming from countries shut out of the market by China's aggressive purchasing this summer. There's still been no confirmation of new deals to China, despite all the talk this week, and crush margins remain negative there. South American weather has also improved, with rains seen in dry areas of the north this week. Still unclear whether Brazil can ship out all the beans it wants to grow, much less grow them. I'm not a super bull in beans. The $20 soybeans some people are talking about could happen, but the ingredients aren't in the market yet. And the discounted deferred futures to the nearby caused by South American hedging, though sharply lower from its highs, still makes holding soybeans long-term into 2013 very risky. Instead, I recommend selling rallies to price your inventory using January hedge-to-arrive contracts and then holding for basis gains into December. Then you can put that deferred discount to work if you're bullish. The spread could be bought on hopes of a rebound, as could call options on the May or July. The initial sales target for November is $16, with more targets around $16.35 to $16.40. When the soybean market was teetering this week, wheat was also on the brink. Futures pulled back from a test of the bottom of their channels, but those downtrends remain in effect. That's the pattern in the year after a summer rally like we saw in 2012. The problem with wheat remains demand. Exports picked up a little this week but remain behind the rate forecast by USDA for the marketing year. Supplies don't look like they'll be tight enough around the world to stimulate much improvement. Dry conditions on the plains could certainly help prices rally. In fact, part of this week's rally came on the heels of winter forecasts from the National Weather Service showing the drought persisting over much of the hard red winter wheat belt. However, it may be hard for the market to get too bullish on that news until later in the winter. Moreover, production out of the Black Sea looks like it's ready to rebound into 2013. The crop there is off to a good start, encouraging growers to plant a little more ground than original estimates. Basis in the cash market is strengthening, and with futures still above 2012 revenue protection prices, selling old crop into rallies towards the top of the trading channel seems prudent. Wheat could be another market where storage on paper could be better for rallies into 2013. Well, that's all for this time. I'll be back next week with another edition of The Buzz.